Aloha folks, thank you so much for checking out this video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to dive in and take a look at a lesser known industrial dividend king. This dividend king has been rewarding investors for at least 60 years with a dividend growth of at least 11% per year the last 20 years. It's a dividend king worthy of looking at. With that, I want you to grab your drink, sit back, enjoy the video, and do me a quick favor and hit that like button, hit that subscribe button if you haven't done so, and don't forget to hit the notification bell so that you don't miss out on the new videos that I put out. As always, all this information is not financial advice. Please make sure you consult with your financial advisor and do your own research. Now with that out of the way, let's take a look at this dividend king and see if this is a company that has a place in your dividend portfolio. So the company I want to talk about is Nordson. The ticker symbol is NDSN. It is a company that manufactures and makes equipment such as pumps, valves, dispensers, and filters. So if you're not familiar with this company, definitely go to their website, take a look at it. One of the things that is really important is going to the website and looking at investors' relations. That way you can kind of see all the information right here with the presentation and all that stuff. Now if we go take a look at the growth of this company, so if you were to invest $10,000, a growth of 10,000 investment, and you want to compare with the S&P 500. So if you would have invested this 10 years ago, let's say June 6, 2015, and then you ended with July 3rd, the price at that time was about $77, and then the shares currently at the time of this video is 200. You would have had a total return of 246. Compare that with the S&P 500 of 115 shares, your compound annual growth rate would have been 16% versus the 10%, and then you would have ended your investment with 34,000, whereas the S&P would have been 21, and the year would be eight years. So definitely check out this company. Now if we go to Y chart, based on their analysis, they rated as undervalued by 14%, and then they have all these valuations over here, the P mode, P ratio, and then the evaluation in there. Now if we swing to simply Wall Street, based on their fair value price, and the estimate is used at a discount cash flow model, they rated as 4% undervalued. Their fair value is about 257. Currently at the time of this video is about 247. Some of the overview on this company is trading at 4% below our estimate. Earnings are forecast to grow 9% per year, and earnings have grown 9% per year over the last 5 years. Now if we swing to Simply Safe Dividend, based on their dividend safety score, they're rated as 94, which is very safe. The dividend yield is about 1.05. Market cap is a large cap. And then swinging over to the key metrics, you can see payout ratio is 27, which is low. Forward payout ratio is 28, which is also low. During the recession, they've increased their dividend, and then the dividend safety streak of 60 years without a reduction. Looking over now to the dividend growth, the last 20 years 11%, last 5 years about 14%, and the latest is 27%. Again, dividend streak of 60 years without reduction, and a dividend increases of 60 years. So you can see from this chart all the way dating back to 2003, and then from what it is currently. Now if we go to the payment details, if you're deciding on investing in this company and you're wondering when you want to get paid, you get paid quarterly in the months of January, March, June, and September. Your annual payout would be $2.60 per share. Ex-dividend date is May 22, which has passed. And then here's a breakdown of the payment ratio, payment details. maybe undervalued based on simply safe dividends assessments. And then you got your dividend yield right here. It is higher, closer to the all-time at the time of 250, and your PE ratio is 26 versus the industrials of 18. Looking over financials, you can see here free cash flow 27. And then earnings per payout ratio is about 12. Earnings per share $9, and free cash flows right here. Sales growth, and then outstanding shares, total sales, and then the return on equity. It's the last 12 months. It's at 22, and then return on investment capital, which is 17. Now, if we swing over to Seeking Alpha, based on their dividend scoreboard, they rated it as a dividend safety of an A, dividend growth is A+, dividend yield is D+, and the dividend consistency is A+. Now, looking at the dividend summary, you can see here are the annual payout, and then the payout ratio, and then the 5-year growth of 16%, dividend growth 25 years. Looking at over here, the dividend grades of safety is A, the growth is A, and then the yield is D, and then consistency is A+. Now, if we go a little bit further, looking at the growth, you can see some of the assessments in here. You got the year growth, for revenue, and then the profitability right here. You got pretty much A+ and all that stuff. Now, swinging over to stock Rover, I wanted to see the risk and return versus the S&P 500 and the comparison with the industry. So based on the 3-year and the 5-year one, 3 years is lagging behind the S&P 500, but the 5-year one pretty much 77% versus the S&P 500, and then Nordstrom is 101. So that's pretty good. Swinging over now to bar chart, and then if you can see, based on their technical opinion, they rate it as a buy. Now, if we swing over to some of the analysis rating, it's a strong buy. It's about 5 strong buy and 2 holds. Now, if we look at the price performance, the 52-week range is 40% up. 3 months ago, it's about 26, and then 1 month's about 19. Some of the key points you want to take a look at is right here. You got first support level about 245, and then to the low, to the third support level 243, and then you got all your resistance points over here. So now, if we continue on bar chart, breaking things down, you can see 3 months ago it's still been a strong buy, and then you can see from right here. Now, if we go over to CNN Business, based on their forecast, they rate this as a high of 270, a 260, and a 225, with the rating of 4 buys, 4 holds, and 1 outperform. Now, we're looking over to alpha spread based on their intrinsic value. You can see here they feel that it's an overvalued by 21%. Looking at the fundamentals, you can see the revenue has been increased by 0.6, and then you got your operational income, your net income, and then operation cash flow. Free cash flow right here has increased 16%. And then your balance sheet is right here in terms of the assets, $4 billion in terms of the liability, cash and short-term investments, and then you got all these other stuff over here. Operation margin, gross margin, return on ROA, ROE. Now, and then you got your fundamentals over here. So that's pretty much it in a nutshell. For me, it's a definite company to invest on. I think it's a great company. They've been a solid company of giving dividends for the past 6 years. So with that said, that is one of the solid companies that, in my opinion, if you're going to invest on a company, this is one that I would definitely take a look at. As always, please remember to do your own research. Check to see if this is something that it is fitting for you, it works well for you, and it matches what you want. As always, please remember to check out the other videos as well. Hope you like this video, guys. Thank you so much for watching. Stay cool, keep investing, and I'll catch you guys in the next video, right? Take care. Aloha.